All right, I think we can start. We have enough people here. Good morning, everyone. So I think the last time we did this voice chat sessions was 2 weeks already, 2 weeks ago. So just want to run through, see what are the topics or what are the questions that you guys have, and then we can go through one by one. I don't have any slides or anything to present this round, so I think we just kickstart the session by going into these questions. Okay. So let me see. Okay. All right. Start from the first one. When will Alibaba recover? So sick and tired of holding this piece of shit for the past year. Yeah. So I'm a bit surprised that there are 26 upvotes. So I thought more people will ask questions about like all this Fed high stuff that happened in the past 2 weeks. But surprisingly, Alibaba came up number one. I think I commented on Alibaba already in our previous session. I got nothing more to add, so I'll just pass around, see who want to comment on this. Chicken, Boonsong, any comment on this? Or Guan, you also can unmute and comment.
I think we should let Keng start first because he's the most prominent Lala investor around.
Hello? Can you hear?
Yes, Chicken, now we can hear you.
Okay. I don't think I'm prominent, but I just like spend a little bit more time than normal people lah. But as in this question, it's like asking when will the market crash, right? I don't think anybody really has an answer. Specifically speaking, I think can be answered with a few other questions also lah. Just saying this is not financial advice or anything, just sharing opinions. The question comes from the perspective probably that you might want to sell, or you might think that China is uninvestable, or you want to deploy the cash, or you want to hold cash, or you want to buy, or you want to rotate it to other stocks. So then I think need to ask a few questions first. Number one, has your thesis for Alibaba changed? If it changed substantially and you're uncomfortable with the new scenario, then sure, I think you can sell out. So the common perspective is always like, you feel uncomfortable with common prosperity policies. That's one. Or secondly, maybe you think that this regulatory tightening thing will come a second round, third round, or fourth round. Or maybe you are uncomfortable with the Evergrande development. Then those are all legitimate reasons to sell out. So that's one, whether your thesis has changed. Number two is, once you sell out, right, what are you going to do with the money? So let's say you have 30 grand in Alibaba today and you sell out. So what are you going to do? You keep the 30 grand in cash, or you're going to buy Apple or Tesla or whatever other companies out there. Then you might need to weigh your risk and reward as well. So also, just to provide another perspective, if you look at S&P 500 returns like 10% average for the last 40 years, right? I think it's the same for any stock that you pick. You need to take the CAGR rather than look at individual year-on-year performance. So like, I think fundamental philosophy is always like, what is the valuation? And valuation always matter. So if you postulate out using whatever methods you have, right? So like you want to use DCF, you want to do some of the parts or whatever valuation methods, you probably have a price target in mind, maybe for 2025 or even 2030. So in that case, you can just do a simple CAGR calculation. And I think I did a quick calculation before. If your price target is $500 in 2030, compound for 9 years, if I'm not wrong, it's around 15%. If you bump it up to 700 price target in 2030, that's 21%. So then you compare this figure with the 10% return, because I believe most of us just want to win S&P 500. So if you have to compare those two figures, and then you look at the risk reward today, then you think about whether you want to exit your position or not. So that's point number two. Then I think the last point also, so I covered Baba thesis, whether you're comfortable or not, looking at a CAGR. And I think the last point really focused on this idea on what you're intending to do with the investment in Alibaba. So is it an investment or is it a trade? And if you're investing, right, I think Ray Dalio quite nicely put it. China's investment is a strategic one. It shouldn't be in and out. But I believe many day traders or people that are trading Alibaba today are exploiting and taking advantage of the entire trend. And I have no qualms against that. And if you know what you're doing, then kudos to you. But I think for generally, if you were to look at investments in China, right, sure, you have delisting risk, you have VIE, you have Chairman C, don't know what he's doing, you have Evergrande. I think the list goes on. But I don't think China has a monopoly over problems. I think every other country and economy all have problems. And if you want to achieve diversification, right, buying a S&P 500 or buying an index fund is good enough. I'm not too sure, but the China trend probably cannot be ignored. And I believe most people that are in the group are probably from Singapore or Malaysia or whoever, or somewhere in Southeast Asia. And we feel the impact of China. And you cannot lie to yourselves that they are not there, or they're not coming up and they're not rising. So in this case, if you want exposure, then maybe you're uncomfortable holding a particular stock because Alibaba is currently the proxy of China and US, right? Then go ahead and diversify out into a ETF lor. And also there's a difference between A shares and H shares as well. So you just need to do your due diligence lah. So that's just my 2 cents on what's happening now.
Thanks a lot. Boonsong, you got anything to add?
Yeah, yeah. Okay, so just now, Keng, I think I share my screen now. You guys could see this Word document. Yeah. Could you guys see the Word document here?
Yes, we can see.
I suppose. Yeah. Okay. So basically, when just now Keng talked about percentages over 10 years means over 2030, not 10 years or 9 years. So, and then he talks about a few percentages. That's expected growth lah. So if your target market cap for Alibaba is 750, I think he said something like maybe, I think 20% or something like that. I can't remember. But the way I look at it is, if you look at a stock and you don't attribute much growth potential into it, right? As I was writing this was some time ago, maybe 3 days ago, the market cap for Alibaba was about 339. So if you were to split out the main operations for Alibaba, based on the interim report, the e-commerce section, right, should probably contribute about 24 billion, 24 billion in annualized earnings. So if we were to give it a PE of 10 to 15, right, it's about 240 to 360 billion. Okay. And then if we look at the cloud computing section, which is a difficult one because there's no earnings as of yet, although the growth in revenue is quite impressive. So the easiest way to value this is to give it a price to sales ratio. And if it's annualized to about 12 billion, and that's being conservative because the revenue is about 5.6 billion interim, means 6 for 6 months. Price to sale multiple of 5 to 10, the cloud computing business could be worth 60 billion to 120 billion. And lastly, there's also the ends group operation. I know I label it as IPO here, but really it's the ends group operation. So about 1.7 USD billion interim, right? That's about 3 billion. And if you give it about 15 PE, that's about 45 billion, give and take. And because Alibaba owns about 33% of the entire operation, it's about 15 billion. And lastly, if you were to add in the cash position that Alibaba has, right, that's about 68 billion. And the number of borrowings and interest-bearing debt that it owes is about 24 or so. So net cash is about 44.6. So if you sum it up together, right, Alibaba is worth a range of values based on likely how much investors are willing to pay for the cloud, how much they are willing to pay for the e-commerce. Maybe the sector for e-commerce gets better then it will be worth the upper range of what I wrote here, which is about 500 billion. But on a worst case basis, I think it's worth about what it's worth right now, or maybe a little bit of discount. So this is purely my opinion. Yeah, that's all I have to say about Alibaba.
Maybe can you still put that document, hold that document? Oh, shucks.
Okay, hold on. I think I cannot share document already.
I think also, right, just to provide some context for people that haven't been following Alibaba for very long. Just now when Boonsong was talking about those valuations, right? At the peak of an IPO, yeah, correct. So at the current valuation using a 15p is around 45p. Last time when Alibaba was still $320, the NIPO was valued at 200 to 300 billion. Just saying. So I think sentiments is true. I think it really do play a very important role in determining how much a particular business are valued at. But of course, people can make the argument that, hey, there are new developments, the Chinese government is cracking down, there's the digital renminbi, etc., etc. So the growth prospects of all these different business arms and verticals might be severely affected. And I do concur. And of course, there's also this idea that even though now the flatline assumption here is no growth, right? What if they experience negative growth because of like the Common Prosperity Fund or however the government wishes to extort money from them? But that said, I think when you think about it from a macro perspective, most of the policies or decisions being made are made to strengthen the middle class. And what happens when people feel liberated with money? They usually just spend it lah. So I think they just want to get the flywheel going in terms of from the government's perspective. And whenever they adopt a few certain policy stances, it's good to think of it from their perspective lah, and try to role play what if you are CCP today and what would you do. So that's just the but of course the baseline is if you're still uncomfortable and you think that they don't know what they're doing, and of course I know that the US and China has different rules they play by, then yeah, if you can't sleep at night, then I think might as well just don't buy lah. For those of you who haven't entered, then yeah.
So just comment on Keng's your point about this China CCP. What they're trying to do is to bring up the middle class, right? So assuming that they are successful, let's say 5 years, 10 years down the road, the entire middle class is much larger than today. Will Alibaba still the best stock to actually bet on this? Because in my opinion, the other alternative will be just betting on like A shares in general. I mean just China A ETF, right? Because with that, you won't be overexposed to all these tech companies. And then you're actually investing in those like older economies, for example, like those related to consumer items and so on. So what's your take on this?
I think I understand where you're coming from. So then goes back to the perspective that, okay, so if you look at it top down, right? If you want to bet the China economy and they're going to grow, right? So maybe index like A50 or whatever, usually if I'm not wrong, it's like the S&P500 proxy. Then they bet on consumer discretionary, manufacturing, chip making, all the things. I think recently also there's this Common Prosperity Index released by one of the Bosch bracket banks, which they tried to include companies from all those that are aligned with the CCP's 5-year goal. These are all very sensible way of investing if you want to bet on China. But that said, if you want to go into stock picking, for example, you have to weigh out your risk reward and what you want to achieve from your investment objective. So people that want to bet on Alibaba, at least for the last few months, is really they just think that the valuation is cheap and they feel like they're betting on China as well. And a lot of like people, foreign investors particularly, they don't have access to A shares. I don't know whether Americans or or people in UK or Australia can buy A shares or not. That's beyond my scope. But they feel like they are part of that growth story. So in terms of I understand the hard economy part, like manufacturing, chip making, all those stuff, right? It does seem like they actually do have an increased focus, at least from the CCP's perspective. And not only that, they're also focusing on green energy and renewables today. So I also, as in currently, I'm trying to expand my circle of competence to look into green energy and renewables, because it seems like, at least on the international stage and international front, they have been flamed by all the other countries, and it feels like they are going to hasten the process altogether. But that said, Alibaba is probably still a relatively good investment. Even though you identify their competitive landscape, like you have Pinduoduo, you have JD, you have TikTok, as in you have Douyin and all the other people that are trying to go into the e-commerce pie as well. Alibaba as a business currently today, if you have to look at the word dog, because it's still shared as well, e-commerce is also just one of the most important vertical. But if for those of you who sat in the investor day, international commerce, cloud computing, technology, autonomous driving, all these kind of things are also part of what Alibaba is trying to achieve. So you're just essentially buying a juggernaut, and especially I believe most of us are also tech investors, and we love this kind of innovation, and we love this kind of promise and prospects the company offer. So at the end of the day, you just have to weigh your risk reward and how comfortable you are in not diversifying when you buy a single stock.
Yeah. I have another follow-up question, which is related to the competition, because I recall the most recent earning release, and when the management talk about their results in the past quarters, right? Yes, we know that the result is not as impressive, at least that's what I recall. And then I think one of the analysts asked Daniel, I think the CEO, like, how would Alibaba attribute the results, right? Is it because of the slowing down of the Chinese economy in the past quarter, or is it because of the competition? And then the comment given by Daniel is that he didn't give a straightforward answer. He basically said it could be due to competition, or it could be due to the overall macro slowdown. So I think the macro one, nothing much to talk about it. I think no point to spend too much because we all know that there's some effect from all this real estate crackdown and so on, right? So that one I think is separate topics. I just want to focus more on the competition part because like you, Chicken, you just mentioned, right? All these other like Bytedance, Douyin, they are all entering e-commerce as well. So competition definitely is getting stiffer. So what's your comment in terms of whether Alibaba is able to fend off the competition?
Anyone else want to like answer? Cause like later become my TED talk like that.
Yeah, anyone who has want to comment on the competition? Because mainly to talk about like all these like JD versus Alibaba or Pinduoduo, Bytedance. I know they are doing a lot of things. It's just that I didn't keep track the numbers, so I actually don't know. Like, I mean, the CEO also doesn't seem to know, right? So I just want to hear like anyone has any input on this with regards to the competition. Because if on the competition, if they lose out, right, then even a 0% growth assumption will be quite aggressive already, right? But for now, we don't know. We need to like find out whether they are still able to compete or not. So Chicken, you comment lah.
Okay. Actually, during Investors Day, I think when the question was posed during the earnings report, they didn't really have a very clear grasp on what's happening yet. Then after that, when in preparations of Investors Day, the new CFO, which is Toby, he came out and admitted that it's both. So macro factors have Alibaba is experiencing some headwind, competition as well. Macro, yeah, like Boon Tee said, I think there's no form of recourse. That one is the government's job. So we only can rely on CCP to solve the problem. All the other competitors are also facing the same headwinds. Then if you look at competitors specifically, I did a speculation in one of my videos talking about after the earnings report as well. I said that there was this idea that people are worried. There's this small portion of the earnings report called CMR, customer management revenue. I think this, you can look at it as like a form of advertising, or however you like to put it. It's like it holds a very big percentage of the entire earnings report. So that number only grew 3%, and people were afraid like that's the biggest revenue, one of the biggest revenue driver for the entire earnings report, but it only grew 3%. So people were saying that, or people were speculating that, hey, Alibaba is essentially trying to subsidize their merchants and to force them to stay on their platform. My take was a little bit different. My take was that I believe we understand that, especially for us living in this part of the group, right? We know the Shopee Lazada problem. Not problem, the Shopee Lazada competition that's going on here. And Shopee has already adopted a kind of like a subsidized and monopolized kind of business model. And evidently, if you have to go in and scroll through both apps, Shopee usually offer a much attractive price point. And how they do it, even though it might be the same merchant, same place from shipping and whatever, but they manage to slash the price lower. So they do so by giving you coupons, by subsidizing here, subsidizing the merchant, subsidizing the consumer. And in this case, you can see that if you have to look at the balance sheet, it is red lah. And it's exactly the same thing in China. And because if you want to go against all this long tail, right, or you want to go against all these market leaders, right, you have no choice. I think the biggest value proposition you can provide is really cheaper costs. And what they do is they will also adopt the same thing. They try to subsidize and monopolize. So that's the business model in mind. And when they were talking about it, right, it's essentially a heightened customer acquisition costs. And if Alibaba were to sit there and do nothing about it, then they're essentially just giving them a very easy time, because if there's an increased demand of like marketing in terms of advertising and in terms of getting more users and acquiring more users, also means that if Alibaba joins in the game, their cost also increases because there's limited resources and limited platform. Then in this case, Alibaba is essentially also trying to stifle them and give them essentially a hard time. So this to me, they also admitted that, as in Alibaba also admitted that this is unsustainable business practices. For both of the, as in for both Alibaba and for both the competitors. And they're just trying to see whether how long these competitors can continue burning investors' money and continue sustaining this kind of practices in terms of user acquisition. So that's just the 2 cents on the competition part. People are spending disproportionate amount of money to gain users. And by gaining users, essentially just means that they visit the platform. And then if they like the interface, they like how things are done, maybe there'll be a convert. But that's a very big question mark. And it's a very big maybe. And in this case, Alibaba is just continue on business as usual. And if you were to look at the main competitor, which is JD and Pinduoduo, right? If you were to observe carefully, actually only JD is punching above their weight. Pinduoduo is also kind of losing out in terms of growth. So PDD is also slowly wavering down. So in this case, you can see that Alibaba and Pinduoduo is losing, didn't meet analyst expectation, but JD is beating expectation. So which is why it's also reflected in the stock price, where JD is a lot stronger in withstanding all the pushing, withstanding all the price movement, while Alibaba and Pinduoduo is being pushed out. So in essence, I can only say that macro on a baseline, everybody is slowly losing out because the whole economy is slowing down. But JD is currently moving up. And also, Alibaba's answer to that is building on their China logistics, because JD's only economic mode is their infrastructure and their warehouses and their what. And I must admit, because even though I like to blow Alibaba up to the moon, right, every time and say that Alibaba is how good a company, JD is also beating a lot of my expectations in terms of creating the supply chain, buying down a lot of warehouses and strengthening their entire infrastructure speed. Like the speed of progress is quite fast. So I do have a small position in JD, but it's a lot smaller compared to Alibaba. But yeah, JD is currently just punching above its weight. But in terms of Alibaba's case, their China logistics is not restricted in China only, by the way. It's a global infrastructure, and they're trying to hit into Southeast Asia and Europe today. So this is just to provide a little bit of perspective on the global level. Yeah.
Wow. Thanks a lot for the detail. Very insightful, I think. Yeah. I think that's I think I as of now, I do see that they are all like spending quite a fair bit of capital just to like fend off the competitions, right? I think all of them doing that, so probably not a good time for all of them. Maybe we need like 1 or 2 more years just for them to consolidate and then saving on stopping all this cash burning, and then hence we will see more sustainable developments. But that one probably will take some time now. For now, I think most competitors are still focusing a lot more on like on the market share. That's why we see all this cash burning. I think, okay, we have spent quite a fair bit of time on Alibaba on the first question. Just take this one and then let's go to the second question. I think actually I look at this second question, I thought, okay, might be the same questions, right? But actually just want to say on the Alibaba company is the same. So I think we have comment enough on this. But I just want to focus slightly more on the difference, which is that the cut loss part. So I don't know what's the context here. For example, like Chicken just mentioned, right? If the person is already like bought into Baba with the expectation to like sell within a short term, basically it's trading, right? Then probably you should already have a line for you to cut loss before it drop like 30-40%, right? So that's one thing. And then the second thing is that if you bought this for a long-term investment and the price drop and then you just want to cut loss. So the question is why, right? Because it's supposed to be long-term. You're supposed to watch the business. As long as the business is still doing well, shouldn't just cut loss because the share price has dropped. That's one thing. Second thing is that, you know, I always bring this analogy like you are investing in a company. It's quite similar to like you setting up a restaurant with a couple of your partners, right? And then let's say if the restaurant business is doing well, and somewhere down the road, one of your partners just say, oh, I don't want to be in this business anymore. I want to cash out. And he's happily cashing out and putting a valuation that is very low to the restaurant, right? Meaning that you only need to pay a low price to buy his stake, right? So I think this one is definitely something that good for those who stay invested, because Alibaba, I just had a quick chat. They are doing the share buyback. I think just in this year, they probably bought back like 10 billion worth of their shares, US dollar. So I think if they are buying back their share at a lower price, right, shrinking their outstanding shares, meaning that all the future, whenever the business growing in the future, right, they are all spread within a smaller outstanding shares, right? So this one is actually, I do see that it is one way for Alibaba shareholders to profit, meaning that you are not only profiting from the business, but at the same time, you are profiting from those who exited halfway, you know? So I think I'll pay a lot of attention to the cash flow, how much they do, all this share buyback and so on. So this is why my view is that if this is a long-term investment, you probably shouldn't cut loss. But if you are trading, then you shouldn't ask this channel or because I'm not a trader, right? So I can't comment on the trading partner. Yeah. And then maybe the third one, which is like if it is too painful, yeah, you know, when people's getting too painful, they always like just cut loss just to make them sleep better, right? So that one you can also do, but maybe don't be so emotional that you just sell the entire positions. You maybe you just sell a little bit, sell to the sleeping point, right? The level that you feel more comfortable. Maybe just 10% will do, right? Then also something that works, right? Because I think all this investment is not just about like earning from the market, right? It's all about like learning, and it's all about like taking care of your emotion and so on. Because if you are getting emotional, then probably your judgment will be impacted as well. So I think that's my take on this. Anyone have anything to add on this second question?
Yeah, Boonsong here. Actually, I also have position in Alibaba. So generally, I think that there's a lot of fear and doubt in your position, not just in Alibaba, but in anything, maybe you should just sell half. That's the common wisdom among investors. Sell half and then just wait.
Yeah. Okay. I don't know why I can't check it out. What's wrong with this? But it's okay. Let's go to the third questions. Is China not investable anymore? I think we briefly talked about this. Anyone has any point to add on the macro side of things? Yeah, is China not investable anymore? Any comment? No one has any comment on this. Then probably we just skip that because we already discussed about this.
Okay. Yeah, actually, Boonsong here. I got something to say about China as a whole. Not China as a whole, but investing as a whole. So I guess I just probably screen share for a while.
Yep.
So generally, right, I believe in screening for companies. So when it comes to screening, there are two kinds of screening. You actively look for good companies and you wait for prices to come to you, or you screen for cheap prices, cheap companies on a periodical basis, like maybe weekly, and then you look for the good ones. So these are the two easiest way to screen for companies. So when it comes to so-called is China investable anymore? So I think there's a lot of opportunities when it comes to China. So I'll just stick to Hong Kong Exchange because this is a website that allows me to screen for companies in Hong Kong and Singapore. So let me start off by looking at so-called dustbin companies, which are cheap companies. Basically, they are companies who have hit their 10% to 52-week low, means they are about 10% range to their 52-week low. So if you look at Singapore, right, the last few companies as of now that fit this criteria are mainly medical stocks and SGX, as well as EV Tech, a small cap. So just to generally explain what these columns are. So ROA 5, right, means the return on asset based on 5-year averages. So these are pretty decent return on assets. And current ratio, this one is liquidity, safety. EV over EBIT, I can spend some time to explain this if you want. So I just actually prepared this. So basically, enterprise value, right, is your market cap plus debt minus cash. And EBIT is your earnings before interest, which is how much you pay for interest, as well as tax. So EV over EBIT, right, is basically a multiple of how many years it will take for a business owner to buy over the company. It means you use the cash that's already in the books, and then you have to pay off the debt that the company owes. And this is how many years it will take for a business owner to buy over the company and get return for the cost that he paid. So obviously, there are some failings with this approach. First, your market cap is subjected to what they call that emotional or what we call Mr. Market whims and whips. But the earnings, right, sometimes these companies could be very cyclical. So you want to look for some kind of consistency. Like, for example, let's go back to Top Growth, right? Obviously, these medical stocks have a very big blockbuster year, and you can look at this EV over EBIT thing, and these are very, very low multiples. But you have to take note that they have a great 1 or 2 years, and this is not expected to be sustainable. So let's move on to the dustbin part, which are the cheap companies for Hong Kong, right? So I ran this screen this morning, and there are probably 64 companies that fit this criteria. So there's a lot more opportunities down here if you just look at numbers. Let's talk about good companies where return on equity is more than 20. This is based on the last 12 months of earnings. So you want to go through all of them to see whether they are consistently earning this kind of return on equity. But the results you see here is based on the last 12 months. As you can see here, there are some pretty good ones for Singapore, 45. Okay. But when you look at Hong Kong, there are 216 such companies. So based on the number again, right, Hong Kong gives you a better chance. Obviously, when it comes to ROE, you don't want to be too optimistic and buy companies like these. For companies that can give you this kind of ROE, usually it's going to be temporary. My personal take is that I often do things called ROA checking. That means I look at return on assets instead of equity, because return on equity can be boosted by leverage. So even when I'm looking at ROA basis, right, there are 21 such good companies in Singapore, and in Hong Kong there are 54. So generally you want to buy cheap stuff or good stuff when it comes to investing. And there are more good stuff in Hong Kong, there are more cheap stuff in Hong Kong. Lastly, to talk about the current situation, right? You want to look at smaller companies. In my opinion, it's better to look at smaller companies, because if you were to put in an idea that China is not investable, the government is clamping down on the profitable companies, yes, it's possible. But when you look at smaller companies, there's a good chance that it can be privatized. When things are too cheap, right, the owners are incentivized to act. You might want to look at good companies, because if you want to buy and hold companies, right, time is a good friend as your retained earnings build up through returns. And lastly, be very careful of companies that looks very good, looks very cheap, but actually are subsidiaries of parents who are in trouble. Yeah. What I particularly mean is that the parents might make use of these subsidiaries to do things to maybe reduce their debt or get them out of trouble. So yeah, that's my take on current China, the current market that we have right now.
Thanks a lot, Boonsong, for the sharing. I think that's a very comprehensive one. Yeah, but just for those who don't know Boonsong, right? He invest mainly on those like smaller caps, and then basically run through all this screener and look for ideas. So Boonsong's investment return, I think, is like very high this year for the past 2 years. So I think this is the result of active investing, because he's looking for those that people are not looking for, and that's where he can find good values, right? Yeah. So it's just that for smaller cap, I think you cannot just say look just invest and just like it's not S&P 500, you know. So smaller caps, the share price is cheap. Sometimes there's reason, so you just need to be more active, and then need to be aware what is the situation with the company, and the research, right, that's required for smaller cap, I think will be much more compared to those larger cap. So I think every investor is different. Some do like smaller cap, some do like larger cap. But if you go into smaller cap, I just think that you cannot skip the research part, because sometimes their price volatility can be quite high also. Anyway, thanks a lot for to Boonsong. Yeah, I think we can move on to the next question. How will inflation's hike affect consumer spending? Will consumer do less online shopping, etc.? Outlook on C Limited. Hope YCX can give some insight on this. I just checked YCX is here today. Hi YCX, you want to comment on this? Not sure whether you're still there, but we can't hear you in case you are speaking. While waiting for YCX, I just briefly comment on this now. I think the recent inflation hikes plus all these monetary tightenings, right, causing all these growth stocks drop quite significantly. Mainly they are like the valuation multiple that is dropping. It's not really like, okay, there's inflation and then all these growth stocks will their fundamentals will be impacted in the next 1 to 2 years. That is not the case. So it's just because like, okay, with higher, because for these growth stocks, right, for example, like C Limited and others in the next questions, right, like all these Snowflake, Upstart, all these companies, their earnings, right, is all like, won't come in soon. Like for coming 1 to 2, 3 years, they're still very low. But because they are growing so fast, you will expect that by, let's say, 5 or 10 years down the road, their size will be a lot larger than today. Meaning that their earnings are all coming in, will be coming later, like 5, 10 years later. So if the cash flow, right, is very long from now, meaning that if you do the discounting, right, higher interest rate, you discount back, and that earnings will worth a lot less. So that's why their valuation multiple will drop if the interest rate increase. In fact, if interest rate increase, all of them will drop. It's just that depending on the timing of the cash flow, it might drop more than the others. And for growth stocks, they will be impacted more. That's one. Second thing is that I think for these growth stocks, right, some of them are still relying on the capital market to fund their growth. I mean, for example, like I think for C Limited, they're still good, which mentioned was in the previous session. C Limited is still okay because they still have the Garena that help them put in some positive cash flow, and they use the cash flow to fund the Shopee, right? So I think they're still okay, but not all growth stocks are in this category because some of them will still need to tap to the capital market, need to sell their equities, or maybe need to borrow from the market, issuing bonds, stuff like that, right? So if the interest rate is higher, meaning that the cost of the capital will be higher. So what that means is that the earnings of this company will really be impacted, right? It's just like you buying a house and then you borrow a mortgage. And if the mortgage rate become higher, meaning you have to pay more for the interest cost, right? So same for the companies now. So this one definitely will impact the growth companies as well. So I think that's my comment on this. I'm just checking one more time. YCX, you have any comment on this? Or anyone else have any comment? All right, no comment. Let's move on to the next one. Should we avoid newer growth companies without good earnings? Example, Palantir, Snowflake, Sofi, Upstart, and UiPath. I think this one is really depends on each investor, because like I mentioned, right, Boonsong focus a lot more on value, like those dirt cheap companies, and he's focusing on those based in Hong Kong because they are cheap, right? So that's deep value or value investing. And then for myself, I think I'll focus more on like quality stocks, FANG stocks, right? And then there are people or investors that will focus on companies that have like 30, 40, 50, even 100% growth, right? These are the very high growth stocks. So all these different companies, right? They are different category, and then they are at different growth stage. So one thing I can say is that if you are investing in these companies, right, your time horizon will need to be much longer. You cannot say, okay, I bought some Snowflake and I hope that the share price will go up like 100% in the next 2 years, right? It's not like that, right? Because if you look at, I think Snowflake, their investor day was, I think, few months back. So you can look at currently they're still growing very, very fast. If you're growing at, let's say, 60%, actually your earnings in the next year doesn't matter, right? Because that is not the key metrics. The key metrics is their revenue and their revenue growth. Because we are looking at these are like the disruptors. They are still small now, but they have compelling products. That's why they are able to grow so fast, right? But it will take time for them to grab a sizable market shares, right? Because they are not like Apple or Microsoft or TSMC, where these companies is already established and already have a sizable market share. They are very small. Some of them actually, if you look at their business, right, in terms of the market share, they maybe just have like, let's say 1, 2, 5% or 3%, right? So they are still like 97% for them to attack. So their runway is very long. So because the company's runway is long and your time horizon also need to be on a similar like long horizon. If not, right, it'll be quite painful if you're focusing on the stock price. So I think my suggestion is that understand why you want to own certain stocks. If they belong to all these high growth companies, then what you should track is their revenue growth, not the share price. If they are like mature companies, then the metrics that you track should also be different, right? For example, like if you're investing in this value stocks, right? Sometimes you just want to bet on a revaluation or re-rating on their valuation multiple, right? So with that, if you focus more on the stock prices, I think that will make more sense as compared to these companies. So need to understand the reason why you own them, and that's one way to put at it. Anyone else have any comment on these questions?
I personally think that when you invest in these kind of companies, right, these are called qualitative bets. You are betting on the management's ability. This is to me, this is very hard to do, but the rewards are there. But you take a lot of time. If you look at Amazon, how long did these people suffer? So there should be some kind of expectation adjustments in your investing, horizon.
Yeah, that's true. Yeah, because it is like qualitative, right? There's story behind it, right? You also need to understand the story well, because if not, right, you buy because your friends say it is a good stock, then probably will be hard to hold, especially when the stock is moving downtrend. Yeah, so need to understand to roughly the qualitative part.
Yeah.
Okay, let's move on. No, okay,
sorry.
Go ahead.
I also accept that when you look at numbers like me, right, it's easier, but the kind of returns that you can get from looking at numbers, right, sometimes, or rather I would say most of the time, it's not as good as what you can get by qualitatively looking at companies. Betting on the management, usually the kind of returns you get is higher than what I can get.
I think sometimes it depends on the environment, not necessarily, because there will be period that is favoring certain style. For example, let's say in the past 1 year, right? Not maybe excluding the recent 1 month, growth stocks is doing very well, but it's not always the case, because there will be period that will be favoring value investing or maybe other styles, right? So all this, they will change, they will rotate one. But it is very hard to predict which style will do well, because if you can predict that so easily, then I think you can just master all this style and just keep shifting your strategy, right? But in my opinion, I think this is very hard to do. The timing of the style is very hard.
Yeah, so basically when we say long term, right, we really need to think very long term. You got what I mean? Because everybody's idea of long term seems to be very different.
Yeah, that's true. For some people, 6 months is long. Okay, let's move on. What's the outlook moving forward into 2022? Any trends or themes, etc.? I'll go first. This one, I think this question is a bit, it's quite broad now, because depending on which market or which style or what you are looking at, you might see different things. But for me, right, I think what has changed, let's say compared to 3 months back versus now, is that this monetary tightening. So I just want to spend like maybe 1 or 2 minutes to talk about this tightening. I think for now, you still remember the day when Jerome Powell announced that they will speed up the tapering by 2x, meaning they will end the tapering in March, and then there will be 3 rate hikes for next year, right? And the inflation number is also quite high in recent months. So I think the inflation numbers will be something that I will pay attention to, because if this inflation stay high, right, what it means is that the 3 rate hikes for 2022 might not be the case. It might become 4 rate hikes or 5 rate hikes, because although Fed, they don't want to crash the market, that is not their intention. But if the inflation really goes haywire, then they will be forced to do more tightening to just cool down the economies. Because if they don't do it soon, meaning that if they just wait, right, the tightening that they have to do later will be even a more severe tightening, and that will have a bigger impact. So if they see something that is brewing too hot, right, then they will have to tighten. And if right now the expectation is 3 rate hikes, right? If this expectation change, meaning that we are expecting to see 4 or 5, what it means is that the valuation multiple as of today, right, will still be expensive, meaning that the share price might continue to drop. So that's why that's something that I will pay attention to. But that doesn't mean that I will sold out my positions, because like I said, right, my position are mainly like really long-term investing, right? I will just hold. But how I position with this is that probably when it comes to buying, right, I might slow down my purchases. For example, I still have some margin that I haven't paid off, right? Maybe I will just focusing on pay down my margin first instead of just looking at the share price drop and I will say buy. I might, how to say, if I comparing now versus 3 or 6 months back, right, I'm a lot less bullish. But doesn't mean that I'm expecting a crash. I don't think that is the case. It's just that we need to set the expectation somewhat lower as compared to 3 or 6 months back. But this is one picture to look at it. But bear in mind that these things is hard to predict, right? Because if the inflation suddenly just drop, and then the Fed can afford to just keep the interest rate low for longer, right? Then maybe 2022 is another year of storms, right? Probably we will see 20% increase in S&P 500. I will not be surprised as well. So it all depends on the all this inflation number and the Fed reaction to it. So that's all my commentary. But with that said, I think if you are focusing on certain stocks, right? If you, for example, like you are focusing on growth or you are buying on Baba, I think all this, I think both this, how to say, I think maybe don't need to focus so much on all this macro stuff. Yes, macro, that will impact the general market. If you understand macro, at least you can explain like why S&P 500 drop or why S&P 500 goes up, these kind of things, right? But if you are focusing on the investment at the individual companies level, usually they will also be impacted, but mostly it will be impacted by the specific company's news instead of the general economy, right? Because you see, when let's say S&P 500 they increase or drop by 10%, that's huge, right? But for individual companies, their volatility is a lot higher. And why? Because there are news or there are development that is specific to that companies, right? So if you do individual stock investing, I think probably focus more on individual companies' news and their developments is something that is more helpful than macro. But for me, I just want to bring this up because I do see this tightening as something that will drive the market in 2022. So I think that's all on this. Anyone else have any comment or any view, any outlook on this to share?
I believe it will be very volatile because there's a lot of known risks already in various markets. So probably I think for US is definitely the elections and the inflation and the interest rate. So that's like the known risk. So the market will probably be like, everyone will be like trying to adjust to like what they believe. Like, oh, if inflation is going to be much more serious, then we're going to be allocating to more inflation, like those that are actually can shield against inflation, those equities and fixed incomes. So that's for US. For China, I think there's too many things exploding in 2021. So probably the outlook in 2022 is to see how they all happen one by one in 2022. So probably is to look at smaller stocks will be still better. I think probably the safest is probably Singapore. I think it's very boring. So apart from the election related stuff in 2022, I don't think there's much to say about Singapore. I think it's quite stable.
All right. Thanks, XB. Anyone else want to comment? Because this question is quite broad, because you might have comments on other things. If no, we'll move on. All right. The next one, should I short Alibaba? I think my answer is very clear. The answer is no. I repeat again, no, don't short Alibaba. Even if you are bearish, you can just stay away. just watch from the sideline. Even you want to laugh at those invested in Alibaba, including me, also can. But please don't short Alibaba. The valuation is so cheap now. I think if they suddenly revert, right, it could revert in quite a very drastically. So not a good idea to short Alibaba. Not just Alibaba. In general, shorting is not a good idea. If you're doing shorting, you better know what you are doing. So I think this is not something that I would recommend. Anyone else want to comment?
Yeah, I see the short ratio is like 19.82% based on the Hong Kong one. So there's really a lot of interest. Maybe it's not a good idea.
Become crowded trade already, right? So yeah, maybe Alibaba will become the GameStop of 2022, you know. I don't know. Just some wild speculation.
It's too big, It's too big. No chance.
No chance. Okay, let's move on. Thoughts on investing in Chinese banks, ICBC, BOC, etc. for the long term. I'll pass. Anyone want to comment? No one investing in this? I think there are, right? Who's investing? Maybe is Eddie here? I'm looking at Eddie whenever comes.
I'm here, but I'm not investing in the equities of these banks. Because traditionally it has always been low valuations. Yeah, so yeah, I only invest in those high yield bonds which are spread across different industries in China. Hello?
Yeah, we can hear you.
Yeah. Okay, yeah. So I also see the big four banks, the valuations, right? It looks cheap, but historically it's also cheap also. It's been cheap like this for the last 10 years, maybe, at least. Yeah, so I don't really see much upside, but also, okay, the other thing is if you want to invest in these big four banks, right, it's going to be a long term. It's not going to be short term, because you have to look at the overall macroeconomics, because I always believe in that. So right, if you look at what's happening, right, China is still pursuing that COVID zero policy, right? And as long as my view is this, as long as they continue pursuing that, COVID zero policy, right, the economy cannot recover. The interest rates will just stay at such levels, and the bank earnings will be muted. It will remain at these levels for a very long time. Yeah, so if you're looking at within the next 2 years, I don't think the valuations for these big four banks will go up much. Okay? At most, maybe 10%. At most, maybe 10%. Yeah, so that's my take on this. Thanks.
Thanks, Andy. So yeah, I'll bring in 2 points here with regards to Chinese banks. I think number one is that I just mentioned about the rate hikes in US. So all this, they don't happen like in an isolated way, because whatever US does, right, it will impact the entire world. So if 2022 onwards is an environment where the interest rate going higher, right, so I think this will benefit the banks. So it will be true for Chinese bank as well. So that's the positive side. But I think the negative side is larger than the positive one, which is all these cooling measures that done by China, right? All this real estate, because banking sector is not just like banking sectors. They are like funding certain activities, right? So I think for housing, it will definitely be one huge part of the business. And now we know that with all these cooling measures that impact the real estate, right? So I think this will definitely have a negative impact. So I think need to be careful.
Interest rates when it go up, right, it only affects US dollar. If I understand correctly, right, the big four China banks, right, most of their earnings are in RMB. If I remember correctly, someone correct me if I'm wrong. Yeah, so because RMB is pushed artificially low, to support the economy, right, which is now pursuing a COVID zero policy, right? I don't think the the bank earnings will be that good the next 2 years at least.
Yeah. But actually, my point is that whenever US hike the rates, right, it will have some upward pressure on the interest rate for the entire world. Although, let's say if you just focus on 6 months, maybe they could diverge, but usually they will converge back because let's say if interest rate is like 2 or 3% higher than today, let's say 2 years down the road, right? So money will flow from China back to US. And then once the capital outflow, they will put upward pressure on the interest rate in China as well. But China is quite special also because they are doing all this capital control, right? So it might not flow, the correlation might not be very high, but at least there should be a positive correlation. I will be surprised if, let's say, US keep on raising rate and then Chinese interest rate getting lower and lower. This one I don't expect. I mean, diversion within short period of time is possible, but over longer period, the correlation should be positive. Although not like 100%, right? But should be positive correlation. So that's a small point. The larger point is all this like COVID impact and also all this real estate. I think this will have a much larger impact. So that's why I myself is not invested. Okay, let's move on to the next one. Biggest problem with investing in China or Alibaba today? Biggest problem, just now we talked a couple of points, right? Like competition. I think Chicken also gave a good point. What else do we have? Like COVID also, Eddie also mentioned a good point. Anyone else, any point to add on this? Just want to, it's as if like we don't have enough bad thesis on China and Alibaba, still want to throw out what's the biggest problem. Yeah, I'll stop here just see anyone has any problem, any point to add.
Actually, right, regarding the bank just now you guys were talking about, right, I share a different outlook for China interest rate though. So I think Boon Tee said actually I do concur that when US hike interest rate, it will have a signaling effect to the rest of the world that most of them will follow suit. But in China's case, because of the developments, right, they are currently like in a very insulated place. So when the whole world is opening up, they choose to lock down. And when US decides to hike the interest rate, right, I wouldn't be surprised in the next 2 years they actually decrease the interest rate to cause the diversion. Because right now, if I'm not wrong, I've been following some of the Chinese officials at like Weibo and stuff. They are very concerned with Evergrande. So at least in the short to medium term, they do have a focus and they always have been chanting stability over the last 2 months. So I wouldn't be surprised if they actually lower rates or increase liquidity. So when US tightens, right, China is actually loosening their monetary policy. And if you were to study like for the last 2 years, right, when the US equities market have been going to the moon, right, China's government is taking a very proactive step to cool down the entire stock market and also cool down the real estate market concurrently. So I think at least for banks, because I'm not personally invested as well, but I do agree and I echo that valuations will probably stay low, and because of the capital movement, right, at least in China's perspective, banks are not really banks. They are just state organs in having a makeup saying that they are private institutions. But they will all work together when shit hits the fan. So in this case, Evergrande is one big problem. COVID-19 is another big problem. And the slowing down of economy is the third biggest problem. And in this case, they will be at the back of the calling of the government. And if the government adopts a different policy stance, they will all react accordingly. And in this case, unless there's blood on the streets, like maybe Evergrande goes down big time, but which I don't believe so, because I believe there will be a very methodical and very thought out process. Unless something big happens and it shakes up the entire financial system, then maybe ICBC goes down another 50%, then there might be deep value. If not, I think it will continue trading sideways, or maybe appreciation or depreciation of just within that band. And one more interesting observation that I was looking at was, I think we all know that renminbi is a very controlled currency. because of the approach and the entire nature of the economy, because they're export driven, they're export oriented. But then when you look at the last 2 years, right, when the whole world is clowning around, right, the renminbi has actually been consistently appreciating because they are exploiting the advantage that I know the rest of the world cannot produce. So you guys have no other alternative. Even though there are, it might be of a much lower supply. So in this case, renminbi has been constantly appreciating. Even though it's still within the band, it's actually hitting the high part of the band. There's a band between the renminbi and the USD exchange. And because of this appreciation, right, it feels like when there might be an export reversal. So it means when the more and more of the world opens up and stuff, people might have more alternatives and more supplies flush into the world economy, right? Which is what Jerome Powell hopes also lah, which help slow down the inflation. But in this case, this appreciation might not be sustainable. So we might go back to the pre-COVID level again, but it might take some time. And with all the developments in China, I don't think it's going to be very soon. So yeah, I think I still hold the perspective that unless there's some black swan or unless there's a huge valuation haircut again on all these different banks, then it might be a good time to consider, but not really in this period of time if nothing happens.
Yep. Actually, I agree with you. Within the short period of time, let's say we're talking about 6 months, right? I think the interest rate will probably not go up or maybe even going down because of all this, like the point that you just mentioned. And on the Evergrande, right, what I heard, right, I mean, with some sources, is that now the CCP is already, they do see that all this tightening in the real estate already have some impact, and they are trying to reverse it already because meaning that they're trying to save the sector already. So there might be some relaxation when it comes to all these cooling measures. So I think that's probably something that is good, but we don't know, right? Because talking about longer term, I think they still don't want the property market to be that expensive, right? Because that is something that they really want to control. Yeah, I think that's all on this question. Let's move on. What is your DCA strategy? I bought a dip, but it kept dipping. I think my strategy is still the same, let's say since 1 year back now. It's always like putting in money every month, and then whenever I see there's any companies that I have underweighted, then I will buy. So nothing has changed. It's just like constantly buying. It's just that now, like I mentioned, the point on the interest rate hike, right? If I'm getting slightly more bearish, then I might just take the money and just reduce my margin. So I got nothing more to add on that. So, okay, anyone want to share your DCA strategy? Do you have any interesting strategy or anything that, you know, some, I mean, DCA is supposed to be something that's simple, right? Like buying fixed amount of money every month. But I do observe that different people, different strategies. Some people will say, okay, I will do DCA, but then I have a war chest. Whenever the market drop by X%, I will buy how many dollars. Anyone has any fancy stuff that want to share? That would be interesting. Okay, no, let's move on. I read that investing in China is not a representation of the China economy. Thoughts? Yeah, anyone want to comment on this?
So I think this question needs a bit more background context.
Since when the economy is a good representation of, the market is a good representation of economy. I don't think the market is any time a good representation of the economy. It either lags or it leads, so it will never be a good representation.
Yeah, that's true. I think this is not just about China. Even for US, right, it's also the same, right? Because let's go back to like 1.5 years ago, right? Just go back to March, April, May 2020. I still remember the unemployment number just shoot up, and then you recall all the headlines, like crazy headlines, unemployment, nobody's, like so many people lost their jobs. And then what else? The GDP has dropped like very, very drastically. And then whenever I talk to my friends, wow, is it a good time to buy now? Stock is so cheap. And they would tell me that, okay, economy is so bad. Why bother to invest in stock market, right? You should protect your capital. And then from May 2020 to December 2020, we're just looking at the market just going up and up and up and up, right? So that stock market keep going up, and the economy, I believe even until end of 2020, it still looks like shit, right? If you just focus on the labor numbers and GDP numbers. So I think at any point of time, economy and the stock market is like they are two different things. One reason is that for stock market, right, we are talking about the share price. There are functions of many things, right? It's not just the economy. There are function of, for example, the corporate profitability means you need to care about the profit margin. You need to care about the growth of the revenues. You need to care about basically there are many things because the GDP can be very high. The revenue can be growing very high if all this growth are those that is not sustainable one, right? For example, like those that you need to burn capital in order to generate revenue, right? Then GDP will still be recorded. GDP will still looks good, but it doesn't trigger down to the profit margin of the companies, right? So that means if you are a shareholder, you actually don't participate in all these returns. You are essentially subsidizing, right? So need to break down the equations, like what are the factors that drive the share price, and then you notice that the GDP is only like one piece of the equation. The others are like I just mentioned, the profit margin, the growth, the price multiple, all these things. So it's not just about China. It's true anywhere. So that's one thing. I think I got nothing more to add. Anyone want to add on this? I think at least my interpretation here is that maybe the person is asking like, okay, China economy might be doing very well in the next 20 years, but is there a possibility that the shareholders don't enjoy any benefits from this growth in the economy? I think that's the question. See, I'm waiting to see anyone has any comment. If no, we'll move on. What are recommended USA stocks to consider investing now via DCA? I'll go first. I think if you ask these questions, right, it means that you don't know which one to pick. And then when we talk about like stock investing, right, it doesn't mean that you need to know exactly which stock to pick, because there's always options for you to buy a broad market index, for example, S&P 500, if you are into USA. If you say, okay, I don't even know whether I should invest in USA, USA looks expensive, and then some say China is good, and then some say Europe is good, right? You don't even know which country to focus on. You can also buy broad market ETF, right? For example, those VWRA, if you can access to UK, or you just buy the VT ETF. That one is like the entire global, right? So I think that should be the base, like the default option if you don't know which one to pick. And you can always stick with that for many years if you don't have time to do the research on individual companies. Then at the same time, if you see any companies that is promising, of course, you can allocate some into those companies, right? So it's really like a combination between ETF and individual stocks. So I don't want to give any recommendations. If you are interested with my view on this, you can just go to my YouTube channel and see which companies that I talked about in the past. And you can watch other YouTubes as well, right? Chicken also have a but Chicken one is quite special. I only talk about Alibaba. You can also watch his video and decide whether you want to invest into Alibaba and so on. But USA, I think that's my comment. Anyone has any comment on this? Any stocks that you think is interesting? You can also share. All right, let's move on. Any website or recommendation for new investor who wants to learn about crypto investing, be it DeFi, GameFi, or NFT? Any comment? I think probably asking the wrong group. I think I think all of us here are like maybe not so into DeFi or this crypto investing. Yeah, I mean, I do invest in crypto. It's just that, you know, within crypto you can invest in Bitcoin, Ethereum, those big one, and then outside of those big one there are many others, right? And then DeFi, GameFi, or NFT, these are areas that is even like further away from the crypto, right? I mean, inside crypto, but further away from like just investing in Bitcoin, Ethereum. I don't have any view on this. I will just pass that, but I will say just one point on this before I pass. Maybe for this, right, you can invest, you can spend some time to watch some YouTube. That's one for sure. But you can also join some group that specifically discuss about all this DeFi, because I think those who are interested in DeFi, right, or NFT, right, they don't how to say, they will usually just discuss all this in group, maybe some Telegram groups or some Discord channels. Just discover those channels and then just participate in the discussion. I think that should be the way, because that's where you can get the latest news, and then also some interesting projects. But maybe spend some time to like figure out how to do due diligence, because I think within this space, right, there are a lot of frauds also. So probably a good idea to learn how to do due diligence. I think that's very important. And then at least, let's say in the coming, let's say 1 to 3 years, right, we don't know what will happen to these areas, right? But at least what you can do within this period of time is just to make sure that you learn the basic, and then you learn how to do the due diligence. And then third thing is you will have try to generate some network or some contact, some people that you trust, so that you know who to approach to whenever you have some interesting project to share about. So I think that should be the way for this area. Okay, let's move on. Question to Chicken or other Shifu who watch Baba Investor Day presentation. Any good points to share? Chicken, you have, I know you are preparing some video with regards to the Investor Day presentations. So while waiting for your video, any point you want to add on this?
I'll be releasing a video probably next week. Still scripting, but it's not really a spectacular Investor Day. There wasn't really anything like mind-blowing or interesting, to say the least. But just interesting points probably. So it was Maggie first, then Toby, then Daniel. So I think Toby did address head on what a lot of people are worried about, which is the increasing competition and the macro slowdown in China. So he was talking about how he broke down all the different product or services offering they have, like Taobao, Tmall, and the new developments or the new startups or investments that they had. I think generally he just focused a lot more on like value proposition and creating value. So in terms of like his membership program, increased value added services, increased time savings, and then he also talked about how they're going to invest better and improving their logistics infrastructure. And yeah, the key takeaway from Toby was really, he said offense is the best defense. So in that case, he also recognized the heightened spending from competitors, which was what I said just now in the customer management revenue. And they said that they're not slowing down. So they essentially just 放话 saying that okay lor, then we just play and we just see who can burn longer lor. Then that's the first part. And I think on Daniel's side, he suddenly focused a lot on ESG investing. And the first time I saw the diagram, he suddenly, like, he put the vision and mission on top, then he talked about the key pillars of the business. Then suddenly below the foundation, he put ESG. Then he said ESG is at the heart of Alibaba. So in this case, you can see that the pivot towards aligning themselves to CCP and Chairman Xi essentially. And I'll be talking a little bit more about that in the video specifically, but it seems like it's not investors that are really looking at the investors' data. It's also the high officials in CCP observing what they're doing, I guess. And they do alluded to the fact that there's a lot of new business models and innovation that will be coming out from the green energy space. Yeah, that's about it.
All right. Thank you. Yeah, looking forward for your video, and I'll definitely share in the group. That will be fun. Next one, I felt like I wasted my youth on Baba rubbish stock. Wow, this comment is too funny. I'll comment on this. Later, you guys have anything to add? Please add. I think my view when I read this statement, right, is like, okay, why are you doing this to yourself, right? Because when we do investing, yes, it is about like building wealth. It's about like investing in companies that's promising, and then when the company is doing well, and then you also doing well financially, right? We all want to get wealthy. We all want to get rich from stock investing. So this is the goal, right? This is one thing. The second thing is that when it comes to investing, you are the CEO, you are the CIO, you are the CRO. You basically take care of your entire all these investing decisions, right? So what you need to do is know what belief that you have, what's your view with regards to different companies, with different markets, and so on. And then you position accordingly, meaning that you actually own your decisions, right? So if you see Alibaba is a rubbish stock, right? To me, I would just say, just stay away, because when I look at the stock market also, I do see there are many rubbish stock, to be honest. Like, even though I'm advocating for S&P 500 or this ETF that actually cover thousands of stocks, right? Meaning that I will still have exposure to this to the rubbish stock, right? But to me, it's not a problem, because I know that the winners, right, will be more than offset those that were not doing well. That's one thing lah. And then the other thing is that I also know that there will be companies that I think is rubbish that turn out isn't. So there will be surprises like this for sure, because, my assessment is just my assessment. If you look at all this long enough, right, you'll be humble to say that, okay, even though each of us has our own view, but usually we are proven wrong again and again, At least this is my personal experience. So back to my point is that if you look at the company and you think that it is rubbish, right, then why invest in the companies, right? You just stay away. Then end of story already. You can just stay away. You can just focus your attention to stuff that make you excited, stuff that you look forward to, and just focus on those, right? Then your entire investing journey, your entire life, right, will be a lot more cheerful, a lot happier, At least that's my point, because another example is that, like, we usually talk about stocks, right? But if you go to crypto areas, right, there are thousands of cryptos, even maybe tens of thousands, right? I would say if you look at those bottom 10,000 cryptos, those are all shits, But I don't focus on those, right? Because if I pinpoint the scam, and then I would just say, okay, this is scam, and then rubbish, I wasted my youth on this. Why, right? Because my time is limited, your time is also limited. Please focus on those that make you excited, make you looking forward to, and invest accordingly. And if you are right, then you will be rewarded, right? That's what I have to say on this. I think the conflict, right, is the person who is asking this question. I think the conflict is the self-conflict, right? Because you don't like it, and then you invested. Like, what the heck, man? Just know like what you think about the company. Like, if you are bullish, then you just own, and if you're bullish, you won't be that affected by the share price, right? Like I mentioned, if your partner want to cash out from the restaurant, you buying back at a cheap price, why not, right? You should just buy more, right? If you are really, really bullish. So if you are neutral, then you can just hold and just wait, because time is always our friend, right? Because we are not buying call options that have decay, right? We own stocks, like myself, I own some Baba stocks. So the stocks don't appreciate away. So I will still own same number of stocks, right? So let's see 5 years down the road whether the share price will increase or not. So I'm at least very patient to wait now. So don't get very emotional, and especially this kind of like very negative feelings, right? Probably need to like structure the mindset correctly. I think this is this will benefit in terms of your investment return. And also the second thing, which is more important one, is that it will make you happier and more optimistic, It will make your life much better. Yeah. Anyone has anything to add on this? Yeah, I think that's all on this. Let's move on. I heard about an investor called masterleong recently via investing note. Any thoughts if his analysis and information is correct for us to learn from? And anyone has any view on this? Yeah.
I got views lah, but I wait for
Yeah.
others to say something.
Yeah, wait for others first. Anyone has any comment? If not, Boonsong, you just go away lah. I think
So
others can add later.
go ahead.
Okay, I think right, he's a very interesting character lah. So he's saying that the US stock market will crash. He's been saying that for the last 2 years. So yeah, so I take it with a pinch of salt. And also his bull thesis on Baba is I feel is flawed because the fundamentals have definitely changed since the crackdown. Yeah, so I mean, there's definitely a bull case of Baba, but I would not be like him and invest everything into one stock. Yeah, that's my take on it. Thanks.
Chris?
Yeah, so I was saying previously, for those who don't know Master Leong actually, he say himself is a long-time investor, 12 years experience. Previously, he was in REITs, then he had dabbled in a bit of tech stocks. Then now he's fully all into Alibaba, and he started bashing US stocks because they are overvalued, and he keep mentioning that China stocks are undervalued. So he has a very extreme point of view, but he's quite entertaining in the way he presents stuff, right? Because he is so extreme. So really, like what Eddie said, take it with a pinch of salt, form your own opinions. Do know that Master Leong, he is a very extreme kind of guy. That's why he has quite a bit of supporters and a lot of haters at the side as well. So really, you have to form your own opinion on that. Yeah, so that's my take on him.
Thanks, Eddie and Chris. Yeah, Boonsong?
Yeah, okay. So this masterleong guy actually has been around for quite some time, since Hardware Zone to Investing Note, and now his own Substack and YouTube. Personally, I think as an investor, right, when you listen to other people, you need to think, like I said, need to think about his opinions, and whatever he say is opinion or a fact. The thing is, yes, he's very extreme, but even, I'm not saying that he's a scum, but even you can learn things even from a scum, because sometimes what he does or what he doesn't do is a thing that you can learn from. Personally, I find him amusing for a few things. First, he claimed to be a value investor, and then whatever he says and his projection is one thing, but if you really am a value investor, you shouldn't be really that affected by what other people are saying about your stock. Because value investing is all about mostly about being a contrarian. So you don't want to be doing what most people are doing. And usually I'm seeing quite a few value investors in my life, and none of them are as emotional as him. So if there's really one thing you need to learn from him, is try not to be too emotional. Second thing I noticed about him is that he tends to buy a lot in a stock, and whether that's a good thing or not, that's one thing. But he tends to start liquidating when he's about 20% in gains. So maybe his idea of selling stock, right, is to make up the so-called return year to date. Because in my opinion, 20% year to date is very good. But I personally would never buy a stock when there's only a 20% discount. Yeah, so lastly, try not to waste too much time. If you are one of those people that are constantly bashing him in YouTube or Investing Note, just don't spend too much time on that, because there's nothing to learn from this experience. Yeah, that's all.
Thanks, Boonsong. Anyone has any view? Because yeah, go ahead.
Can I say something? Okay. I think Master Leong actually reached out. I didn't know him previously. As in, because I wasn't on Hardware Zone, I wasn't on what? Because yeah, given my age, I also don't really have. Last time when I buy stock, I just buy those I know government will support one. So I started investing in Singapore. I buy like DBS, Keppel Corp, Semco Industry, those kind that I see everywhere and what. So then when I started doing YouTube on Alibaba, right, and yeah, I echo whatever everyone said. He's a big Alibaba investor, so that's probably why when he typed in Alibaba, he found my channel. So he shot me an email and he gave me his Substack subscription. I didn't really spend too much time because I don't really check my email. That's why. But when I do see him constantly bashing on the US stocks lah, and I thought that you don't have other people don't have to be wrong in order for you to be right. So that's my baseline. And I wanted to also emphasize on what Boonsong said. I think for value investing, why is it contrarian? Because like Buffett always say, right, it's like when there's blood on the streets, then that's when you start buying, and when there's like a huge margin of safety situation. So when the stocks just keep tanking, then everybody will be scolding you. And I don't know whether anyone is a supporter of mine, but if you really want to look at how extreme views can get, I think you can look at my comment section, which to an extent where I don't even really check my comments anymore because of it kind of affects your views lah. But I do understand where Master Leong is coming from. I'm not supporting his views, I'm not supporting his emotions, but sometimes you can get into his head lah, I guess. But back to his views, I don't principally agree with a lot of things. But that said, his courage has to be admired lah. I think he's 500,000 or 1 billion in Alibaba, and he has a small position in Tencent, so he only has 2 stocks in his portfolio. I think 25% in Tencent and 75% in Alibaba, and he owns around like I think 500,000.
He liquidated Tencent a long time ago. He liquidated Tencent a long time ago. Yeah. His
I didn't
now
follow.
is only about his Alibaba portfolio is less than 200k, and a lot of it is leverage. He doesn't have much left. He lost a lot of money on Alibaba.
Okay, yeah, that one I'm not updated because, like I said, I didn't really follow him. But that said, because I recently interviewed another guy. I think it's an American investor, by the way. I think he has 13 million in Alibaba and he has also 1 stock only. So he only has Alibaba in his portfolio and he has 13 million in Alibaba. So I guess whatever floats your boat lah, and you as an investor should know why you're investing in particular stocks. And this diversification versus no diversification, whatever kind of school of thought that you subscribe to, everybody can give you the correct answer. Means you need to diversify, you need to constantly invest and stuff. But at the end of the day, you just need to be accountable to yourself lah. So that's just my 2 cents.
If anything you want to learn from Master Leong is he's like what Eddie said, he actually sold quite a few Alibaba, and that is to meet margin loans. That is if his words were to be believed, because that's what he's saying, right? There's no documentary proof. Yeah, so anything to learn, try not to margin too much.
Thanks a lot. Yeah, I think for me, I read like I think a couple of his Substack posts before. I didn't follow him that much, so I don't have so much opinion. It's just that for whichever content creator, right? Like it could be YouTuber, like you are watching, right? I think for personality like Master Leong, I think he's very good because he's very extreme. And usually you need to be very extreme and then you can get a lot of views, right? Because whether people are bullish or people agree or disagree, they will want to listen to you. And the way he presents his materials, his content, right, is very, how to say, entertaining. So I at least when I read his post, I feel entertained. But I think whether like, because the question here is asking like whether his analysis and information is correct or not, I think because we don't even, I don't even know like which analysis and information that you're referring to, right? So it's very hard to answer these questions. So I think it's better for you to like, I mean, it can be content from Master Leong or it can be content from Keng or me, right? You have to verify the information yourself because, you know, this is your investment decisions, right? So you need to be accountable, because if I give some wrong information and then you listen, you shouldn't trust, right? You should verify yourself also. So I think this is true for any content that you are consuming. It's always good to cross-check. Okay. I think that's all. Let's move on. I guess I guess if one were to just DCA or invest in S&P 500 throughout 2021, would have beaten a lot of individual stock picking. I think this statement probably true. I think mathematically speaking, right, S&P 500, right, will always be like it is, although it is like average of the market, right? But when you look at the distribution of the returns, right, usually it is above average one. So I think this is a bit technical for me to explain in here, but just I wouldn't be surprised, and this usually will be true like every year. So quite interesting, because you know, for S&P 500 is doing well, usually it's not because like all 500 stocks doing well. It's because there will be a couple of names within S&P 500 that goes up a lot, and they could go up like 100, 200%, right? And that will actually bring up the returns. And usually it's very hard to guess which companies that will go up so much, you know. So I think this is definitely true. And also the second point is that I do observe that companies that are very, how to say, popular, right? People that talk a lot, especially those like high growth names that we all talk a lot also, they went up quite significantly in the past 1 month. So definitely I would say individual stock investors is not doing as well as S&P 500. Third thing is that for those who invest outside of US, if you focus on any companies, right, could be Baba, could be any Chinese stocks, right, then for sure you are lagging S&P 500 just because of how well the US is doing in 2021. But at least that is comment on 2021. We don't know what will happen to 2022 and 2023. So it could be that if you are investing in good companies, your companies can perform a lot better, right? Tesla is a good example. I think in 2020, prior to 2020, they are actually not doing that well compared to S&P 500. Right? It's lagging for quite a number of years. And then just in 1 year, it made up all the underperformance in the previous years, right? Yeah, I think this is also something to note too. Anyone want to comment on this? Want to share? Has your return beating S&P 500? I think Boonsong, yes, I can answer for Boonsong. Yes, Boonsong beat the S&P 500. Others, if you want to share, you can share. If not, we will just move on. For me, for my return, I just like very close to S&P 500. I think slightly above, very, very slightly. Chris, you are saying something?
Yeah, I just want to add a point on DCA S&P 500. A lot of people did not appreciate what DCA S&P 500 really gives you. It frees you up a lot of time that you can actually use to spend on other kind of thing that you want to do. Like for example, earning more income. Just DCA S&P 500, you don't have to go and look through all the investor presentation. You don't have to look through all the mini details, follow the news and all that. So, I mean, in the grand scheme of things, S&P 500 allows you to actually have a certain bit of freedom to go and pursue other things that may earn you more income than spending time looking at all the charts and stuff. So that's just something that a lot of people did not realize. So that's just my point on that.
100%.
I'll echo that as well. Your time is not free, by the way. Your time is very variable. Money can always earn back, but time, you can't earn it back.
Yeah. So a better strategy might be just invest in S&P 500 and use the free time to do what? Grab deliveries? Yeah, just joking. I think that's true. I totally agree. You even if you are not earning monies like explicitly, right, you can just take the time and learn something that will increase your active earnings, right? You could do there are all sorts of activities, right? So you learn about it. You can learn piano and then you can teach piano later. You can teach tuition. I think there are many different ways to earn the monies, and that will be much better than like doing stock pickings, right? Yeah. Especially the portfolio size is something that is very important. Unless you have 10 millions and then you just need to outperform by 1% and then you will make up, right? And then that is a different case. But for most of us, I think we don't have 10 millions, right? Even if you have 100,000, I think it's still investing in S&P 500 mathematically still works, right? Because to beat S&P 500 is very hard already. Yeah. Next one. What about Facebook? Do you think it is a buy in 2022? Anyone want to comment on this? Because I actually don't recall anyone who is really like a big bull on Facebook. Any comment? Okay, no comment. I will comment a bit on Facebook. I think if you look at the big tech, right, Facebook valuation is lower than S&P 500, if I recall correctly. Their earnings has been quite strong. If you look at all these innovations in disrupting the marketings, right, I think they are doing extremely well. Like Facebook and Google, these are the companies that leverage, how to say, they actually leverage a lot on the network effect, and it's very successful business. And when you look at the valuation, it's also very attractive. So I think these are the two main points that I think it is a good investment. And that's also why I have invested in Facebook. The reason Facebook is not a huge allocation in my portfolio is that I do see there's a lot of disruption coming. I think one good example is TikTok. I personally have a Facebook account. Sometimes I also swipe Facebook, and sometimes I also use TikTok. I just think that those that is coming, right? For example, like TikTok, right? They are a lot more engaging. So I don't want to downplay the competitions coming from this other social network other than Facebook, for example, like all this TikTok, right? So that's something that I am quite concerned. If there's no TikTok, right, I think Facebook will be a lot larger allocation in my portfolio. At least that's my point. So the positive and negative. Yeah, I got nothing more to add. It's just a small allocation in my portfolio. All right, next one. What do you think of NEO? Do you think it has bottom or there's more downside to come? Anyone want to comment on NEO? Anyone invested in NEO here? Because we have how many people here? We have quite a number of people. Right? Anyone invested in NEO? Can share your comment. Why you what's your take? Okay, no comment. Okay, for this question, I really don't have an opinion. I just know that there are EV companies, and then they do some battery swapping. Haven't really done enough research.
Maybe I can talk a bit about NEO. I don't own NEO. I own the Tesla, but just talking from my perspective, NEO is actually doing very well in China. They are putting themselves more as a lifestyle company rather than a pure EV company. So you can see that they are pushing a lot of like a prestige, a lifestyle. Like they're doing like an Apple way of marketing their products. So you can see that there's also the loyalty aspect from their products. They give a lot of discounts and incentives for people to stay within the brand, and that's talking from the customer side lah. And talking from their technology side, they are also pursuing a lot of new technologies. But what I don't see is that they do not have a clear path to be different or better than the others. They are more like let's put everything faster and bigger and nicer and more luxurious. And that's from the innovative side lah. But I think they are very fast. They do create a lot of new products and a lot of lifestyle products for their customers. One of their competitive advantage is the battery swapping and battery rental technology that they give. So they give a lot of choices to the customers. Their products where you buy the battery outright. That means like a Tesla. And like either other auto manufacturers, you can also rent it, so you pay a significantly less amount upfront for the vehicle, and you pay a monthly fee. So you rent the car, and you don't need to worry about the battery after a certain period of time. Then there's also the battery swapping, and they give actually I think free swapping if you want. And then I think it's included in the price already, so you do not need to worry about your charging prices and everything. Then also some small things. Yesterday they just had their NEO day. They launched their long-awaited ET7, which is the large size sedan, which has been delayed a bit already, but quite well received. Going to launch next year in March. So we'll see what is that. But I think the main driver for their income in the next year, or actually 2023, I would say, is the ET5, which they just revealed yesterday. It's a quite compelling product. It's about, I think, below 300,000 renminbi, which is actually very attractive price. And they say they have the high end one will go up to 1,000 kilometers, but with a very big battery pack. So then that would maybe be their main income driver. So you can compare this to the Tesla Model 3. So if you want to see revenues really growing, I would say wait until 2023, you can see. But now they are still loss-making, so you have to be careful and see if you want to bet early to hopefully that they can bring in their revenues with the ET5. And one more thing is, I lost my train of thought. I think that's about it. That's about it. They are also expanding a lot of their supercharging. They also call it superchargers across China. One risk is that they are not expanding globally and they are very focused in China. I think that's it. If you have anything, you can let me know.
Yeah, thanks for the insights. Definitely interesting.
I wanted to ask Kelvin, for the battery swapping, right? Do you think it's a superior tech, and how long or how durable this advantage would be compared to normal charging to other EVs?
Why I'm talking from Tesla's point of view, right? Why Tesla did not go for the battery swapping is that the industry is actually battery constrained. So there are actually too few batteries. So Tesla thought that it's not viable to actually have batteries waiting for people to come and swap. So they decided against it. And also there is already an infrastructure for charging, which is our homes. And also that if they create like supercharging, they can the capex is lower. So what NIO is doing is they are more of a lifestyle company. So they think that if we can create a special like a community sense to all their users, they would be more welcoming. One thing is that the growth in their swapping is not as aggressive as their supercharging, because as you can see now, NIO is actually pushing more towards their charging as well. So they only concentrate their battery swapping in certain like strategic areas, because you can imagine actually the capex is crazy, And then and you can see also now they are providing like 150 kilowatt hours battery, which can go 1,000 kilometers for their new car. So I don't think battery swapping would be a big advantage to them. It's just that it's just something special they have to provide to some of their legacy customers, I would say, their early customers. But I don't think they will pursue it further. And also the cost size is a very, very big cost. You are actually putting batteries there waiting for people. It's not scalable as easily as a charging network. Another thing also I see that was good with NIO is that they are really pushing their message of environmentally friendly more than actually Tesla is doing. So they are going with like recyclable materials in their cars. They are going for all biodegradable plastics. They are also going for fully recyclable batteries where you can like now you can also choose not to own the batteries, so that they can use their old batteries to like create those power storage. They're also going like Tesla. They're also doing some power storage business. And just going back to just to sum it up, I think the advantage is not high lah. The capex is too high. I don't see the business case for them to push forward like in other countries or in regions outside of China.
Thanks, Kelvin.
Thanks, Kelvin. Okay, let's move on. I think we have just a couple more questions, then we wrap up now. Okay. How about Ethereum in 2022? I do see a lot of gaming companies stepping up on crypto world or metaverse. I don't have a view on this. Anyone want to comment on Ethereum? Yeah. No comment, right? But I do think that in general, all this like metaverse, crypto, this are promising future. Just that if you are asking, if you are looking at this development and think that, okay, Ethereum price should shoot up in 2022, I think that is very, very hard to say. All these crypto, they are very volatile in their price. And then, I mean, if you compare Bitcoin with Ethereum, what is different about Ethereum is the smart contract features, right? But then there are also so many different coins that all have their own advantages when it comes to smart contract plus the crypto, right? For example, Cardano, this is something that's based on proof of stake, and then they are more energy efficient. So they are like a Ethereum killer, right? So there are others like Solana and so on, right? So I think if you are bullish on this, I think probably good idea to like just do more research on them. But I personally don't really focus too much. Yeah. Any view? If not, we move on. Yeah. Stop me if you have anything to say. Next one. Would there be any tax charge from SG government under US or under US if we do sell stocks such as from US market? The answer is no. For US market, if you are not US tax resident, you are Singapore tax resident, right? You only need to pay the withholding tax, which means any dividends that you receive, 30% will go to US government, not SG government. All right, let's move on. What do you think of buying only SPY and on margin, assuming SPY average 8 to 10% returns over long run, and you buy twice of available cash, return are one? I think basically you want to say the return is double because you leverage, right?
It's a two-parter. This question, there's two parts.
Okay.
If you scroll down, you see the second part.
Then the returns are around 15 to 19%, assuming IBKR margin and SPY is 10% as well, giving significant buffer for drawdowns. Would this help make investing simpler? Actually, this strategy, right? I have one friend who's actually working in the investment industry. So really doing all this portfolio management, asset allocations, really very knowledgeable guy. His strategy is basically really this, like investing in S&P 500 and just 2x the leverage. But he's not using SPY and margin. He's using futures. I think he's doing very well. If you look at the S&P 500 return in the past, let's say I don't remember he's doing this for how many years. Let's say past 5 years, right? You look at S&P return and then you just double the returns, right? It's very, very high. So I would say that yes, in the sense of if you believe S&P 500 is still the way to go and you want to increase the return, right, then just leverage. It will work now. It's just that the downside is that if you do this, right, and you think that the market will not drop 50%, right, I think this is not the way to think about it, because the broker will not wait until your capital wipe out, to liquidate you. It is before that they will already liquidate you. So take some, for example, like if you have 100,000 cash and you say, okay, why not I just buy 200,000 worth of S&P 500, right? And then you just borrow 100,000. So you 2x, right? Sounds easy. And you say, okay, as long as market don't drop 50%, and so your portfolio will not go to zero, right? Mathematically, you are right. It's just that you need to understand the maintenance, margin calculations, like all these ratio parameters that will change during market stress. Probably if market drop by 30%, you already get liquidated, right? So that's why I would say don't margin that much. If you want to margin 10%, 20%, I think that is still quite safe. But if you margin like 2x, right, you better know the margin calculation inside out before you do that. And that's one thing. Second thing is on the emotional, because, S&P 500 has been doing so well in the past 5 years, right? Let's say in a single year, it could drop 20, 30%, right? If you double up the returns, right? Meaning you leverage up, right? 40% drop. Can you take that or not? So That's why I would say probably not a good idea to go like 2x. You want to like do a 20%, 10-20%, I think still okay on S&P 500. At least that's my take. Anyone want to comment on this? I still recall we discussed about the margin in our last call with YCX. I think since he's not around, I saw his name here, but he's not commenting. I would just comment the same thing. Whenever we talk about margin, right, his answer is no, don't do margin. You just invest in S&P 500, right, is good enough already. Because these companies, right, imagine that you invest in these companies, Apple, Microsoft, all the 500 companies in S&P 500, right? These companies, they themselves already issue debt and they are on leverage already. So you don't have to do leverage on leverage now. So 8 to 10% per year, right? As long as you invest consistently and then as long as you put in money in your portfolio, what you need here is not higher return, Actually, what you need here is just take this 8 to 10%. This is average, by the way, because in any particular year, you can have down 20%, up 40%, right? So average out 8 to 10%. What you need is just to compound this over a long period of time. You just need to compound 20, 30 years down the road. Your portfolio size will be very sizable. You don't have to worry on that. You don't need higher returns, because if you do leverage and that screw up with your, like, whenever market drop and then you become emotional and you do stupid things, right? And that will actually kill your portfolio. And it's not about like, okay, I don't have a 15%, but 8%, so my portfolio is screwed up. No, your portfolio will not screw up by investing in a return that average out 8 to 10%. It is the emotional part. So that is something to watch out. My another suggestion is that if you really plan to do a 2x leverage, right, maybe you choose a time when market is in a very serious stress, like really market is panic, right? Something like March 2020, right? In those period, you look at your portfolio, it's already down like 20%, already red, you're already losing money, right? And you say, okay, I want a 2x leverage. In that period, if you still can convince yourself to leverage up slightly, then I think maybe it's a better time, at least compared to now. Because if you look at S&P 500, I think we are still quite close to all-time high. So this is the period that usually people will want to be greedy, and usually this is not a good time to do this kind of crazy things. So I think, like, to conclude, it's just that maybe don't do leverage so much. Okay, let's move on. Please stop me if you want to comment. If not, we move on. Get one or two more questions. I think finished already. NEO bottom now and slowly rise to 40 to 50. I think I have no more comment. I think Kelvin just now gave a good commentary on NEO. Focus on the business, don't focus on the price. Even if whatever Kelvin just mentioned, right, like the business is doing well, the growth is all doing well, and then their strategy is all good, right? Even with that, the price may not reflect it right away, right? So don't focus so much on the price now. If you think the business is promising, then what you should do is just accumulate the stocks. If not, then you just stay away. Price is always something that you cannot control. And if you try to focus too much on the price, it's very tough, You will be unhappy most of the time. All right, let's move on. Which Chinese stocks good to invest in right now besides Alibaba or Chinese tech? Well, I think this is a good question because whenever we talk about Chinese companies, we always focus on the big one, right? Which is Alibaba, Tencent. Maybe I will put in Meituan here as well because I have invested. But if you exclude Chinese tech, I think the big one will be maybe like those bank stocks or maybe like China A, those companies, right? I think for me, I will focus on ETF because I don't have insight. Anyone want to share any? I think this question is worth discussing. And yeah, any view on this? Yeah, I think this is something that's worth to research on. But for now, I don't have any opinion. But you can actually, for those who are still listening, right? If you later I will post this video, you can just rewatch again the section on Boonsong talking about like the screeners that he's doing, right? I think if you do the screening and you look for values, maybe you won't see a number of Chinese tech in there, because Chinese tech, they are also, like, in terms of valuations, of course they are higher, right? But for if you run through the screener, you will see quite a number of companies that is not tech related, and I believe quite a number of them are actually in terms of valuation is quite attractive now. Just 2 days ago, I looked at Hong Kong Stock Index, Hang Seng Index, right? They are at around March, not the bottom, like absolute bottom during March 2020, but they are quite close already. So it's quite interesting that Hong Kong stock market just dropped so significantly now. So maybe you can take a look at those that is listed on Hong Kong. Yeah, for China A will be more difficult because I don't know how it works, like with all the stock connect, whether we can buy or not, I also don't know. For me, if I want, I just buy China A ETF. But for Hong Kong one, if you want to pick stocks, you can look at those. All right, I think we covered all questions. 2 hours. Thanks a lot for tuning in, and special shout out to those who contribute, like Keng, Boonsong, Eddie, Kelvin. Who else? Did I miss anyone? Yep. So I think thanks a lot for joining. Yeah. Enjoy your lunch.
Thank you.
Thank you. Bye-bye.
Bye-bye.